Let's get right into it. Welcome to our explainer on the fascinating and, honestly, highly misunderstood world of the futures market. Today, we're breaking down the actual insider playbook that professional traders use to navigate this absolute giant of a financial arena, a place where incredible amounts of capital change hands literally every single day. But to really grasp how this complex global market actually operates, we're not going to start on Wall Street, and we're not starting in the trading pits of Chicago either. We're actually going to start at your local drive-thru.
So, quick question for you to kick things off. How exactly did the futures market invent the Chicken McNugget? I know it sounds like a joke, right? But it's actually a brilliant real-world example of why these financial instruments even exist in the first place. Years ago, McDonald's really wanted to launch the Chicken McNugget, but they hit a massive roadblock. See, there was no regulated futures market for chicken meat. Without a stable, predictable cost for the chicken itself, McDonald's couldn't realistically set a menu price without risking enormous losses if chicken prices suddenly shot through the roof. They were completely stuck.
Enter legendary investor Ray Dalio. He ended up giving McDonald's a piece of advice that totally changed fast food history. Since there wasn't a futures contract for chicken, Dalio basically told them, hey, just build a synthetic future. How do you do that? Well, you look at what chickens eat. The price of chicken is heavily tied to the cost of chicken feed, specifically things like wheat and corn. So McDonald's producers jumped right into the futures market, bought up wheat and corn contracts, and effectively locked in their feed costs. With those costs secured, the price of the actual chicken became calculable, meat prices stabilized, and boom, the McNugget was born. It perfectly illustrates the real-world value of these markets. They aren't just for Wall Street speculators, they're absolutely essential for the everyday stuff we consume.
Okay, let's move to Section 1. Entering the arena. What is a future?
At its core, a futures contract is a derivative financial contract that legally obligates the buyer to purchase an asset or the seller to sell an asset at a predetermined future date and price. Now, the absolute key word here is obligating. This isn't like an options contract where you just buy the right to do something if you feel like it. A futures contract is a binding agreement. The price is locked in the second the contract is executed, and the fulfillment time is totally set in stone. And because these contracts are highly standardized, they can be traded super easily on exchanges, which keeps trading costs nice and low while keeping transparency high.
Now you might be wondering, how does this actually differ from just buying regular stocks? Well, it really boils down to the underlying asset and the concept of time. When you buy a share, you own a perpetual, fractional piece of a company. You can hold on to it forever if you want. A future, on the other hand, is mostly based on a real physical asset like corn, wheat, oil, or even a financial instrument, and it always comes with an expiration date. Now, a lot of people immediately panic and think, wait, if I buy a corn future, am I going to wake up with 100 truckloads of corn dumped in my front yard when it expires? Honestly, don't worry. Something like 99% of these contracts are just settled in cash by offsetting. That just means the trader takes the exact opposite position right before expiration to close the whole thing out.
All right, Section 2, the map and the players. Reading the market.
To an outsider, the futures market probably looks incredibly chaotic, but I promise you, it isn't random. The participants in this arena basically fall into two massive heavyweight categories, the commercials and the non-commercials. Your commercials are the hedgers. We're talking giant, real-world corporations, Boeing, Starbucks, General Motors. They aren't out there speculating. They use this market strictly to protect their core businesses. Like if Boeing is selling planes to the UK, they'll buy futures to hedge against the British pound unexpectedly dropping in value. Then on the other side, you have the non-commercials. These are the large speculators, your hedge funds, your big institutional traders, massive banks like Goldman Sachs. They're in the market for one reason only, to make a profit off of price movements.
So here is the million-dollar question. How do we actually know what these financial titans are up to? The answer is the CFTC Report. The Commitments of Traders Report is published every single week by the U.S. government's Commodity Futures Trading Commission, the CFTC. I'm telling you, it is without a doubt the most insightful market report put out by any government agency anywhere. It basically acts as a highly transparent map showing us exactly where the smart money, the big boys, are actually placing their massive bets.
And the best part? They literally can't hide. It's all because of reporting limits. Once a trader's open positions hit a specific, legally defined threshold, they are required to report their activity to the CFTC. Just to give you an idea of the insane scale we're talking about here, let's look at corn. A trader has to report if they hold at least 250 contracts. Do you know what that equates to? That's trading more than 127,000 kilograms, or 127 tons, of corn. As the source material jokingly points out, you can make a hell of a lot of popcorn with that. But seriously, when you add all of this mandatory reporting up, the COT report accounts for a staggering 70 to 90% of the total volume in these markets.
Moving on to Section 3, the insider strategy, cracking the COT signal.
Okay, so knowing that commercial hedgers are generally buying or selling is nice, but to actually make a profitable trade, we have to know when their positioning reaches a total extreme. To do this, pros calculate what's called a commercial index based on that COT data over a 6 to 12-month period. And here's exactly how the signal works. If the index shoots up above 75, it triggers a long signal. That means the smart money is overwhelmingly buying, and a bullish trend change is probably right around the corner. Conversely, if it tanks below 25, that's a short signal. Slow, creeping transitions are one thing, but when you see rapid, almost panic-level buying or selling by these massive commercial players, that is a huge flashing red light that the trend is about to flip.
But listen, a signal all by itself is definitely not enough to risk your hard-earned capital. You need confirmation. Let's walk through the strict 4-step filtering checklist that pros use to confirm a signal's reliability. Step 1, does the COT signal actually align with the longer weekly trend? Step 2, look at open interest. If we get a long signal, we really want to see commercials buying up contracts while the overall number of open contracts in the market is actually dropping. Step 3, sentiment. This one's kind of funny, but basically we want the crowd to be dead wrong. A long signal is way stronger when the general public's mood is overwhelmingly negative. And finally, step 4, seasonal trends. Does the historical time of year actually support the trade you're about to make? Honestly, you want at least 2 or 3 of these confirmations before you even think about pulling the trigger.
When you put it all into practice, it's pretty incredible to look at. Green arrows represent those long buy signals, and the red arrows are your short sell signals, all triggered by those extreme commercial index levels we just talked about. You can see clear as day how tracking this extreme sentiment captures major turning points in price. But definitely take note here, not every single arrow perfectly catches the absolute bottom or the exact top. It's a zone, not a crystal ball.
Which brings us to Section 4, pulling the trigger, executing the trade.
Getting a reliable signal is one thing, but actually getting into the trade requires a totally different tool set. So please remember this absolutely crucial point. The COT index is not a timing indicator at all. It tells you a massive shift is highly likely, but it does absolutely nothing to tell you when to actually enter the market. If you get excited and jump in too early, you're gonna get wiped out. To properly time the entry, traders zoom in. They switch from that broad weekly data to daily charts, and they lean heavily on technical analysis. They're looking for things like momentum divergences, where the price drops to a crazy new low, but the momentum indicator just refuses to follow it down. They also wait for really specific triggers, like waiting for a 12-day price extreme to be firmly broken before finally entering the trade. Basically, you have to force yourself to wait for the daily trend to actually confirm the reversal.
And now, Section 5, the ultimate boss, the trader's mind. Here is the brutal truth. You can have the absolute best COT data in the world, the most perfect technical entry timing, and you can still lose everything. Official figures show that 80 to 90% of all traders lose money. Why? Well, I think the answer is perfectly summed up in this powerful quote from the legendary trader Jesse Livermore. He said, "The chief enemies of the trader are always boring from within." The harsh reality of trading is that your main enemy is not the market, it's not the algorithms, and it's definitely not the hedge funds. Your main enemy is you. It's human psychology. Greed, fear, and a simple lack of discipline will ruin your account way faster than any sudden market crash ever could.
So what do? Your only real defense against your own worst instincts is having rigid, completely uncompromising risk management. Before you even think about entering a trade, you have to know exactly where you're getting out if things go south. Professionals rely on strict stop-loss rules, like, for example, setting a hard, non-negotiable exit at the most recent 3-day low. They also ruthlessly manage their position sizing so that one single bad trade doesn't blow up their entire account. It's really all about surviving your own emotions so you can live to trade another day.
So, as we wrap up this deep dive into the playbook of profitable futures trading, I want to leave you with one final thought. You now know exactly how to track the smart money, you know how to filter and read the signals, and you understand the underlying mechanics of how this all works. But the ultimate question remains, do you actually have the discipline to conquer yourself before you try to conquer the market? Think about that the next time you're staring down a stock chart, or for that matter, the next time you're eating a chicken McNugget. Thanks for joining me on this explainer. Keep learning, and I'll catch you next time.